All right, everybody, it's 9 o'clock, so let's go ahead and get started. My name is Tyler Thrush, and I am the broker owner of Maltese Mortgage. And today we're just going to talk about being a first-time home buyer. So myself personally, I've been in the real estate and mortgage industry for 20 years, a little over 20 years. And I personally have been a first responder for a little over 13 years now as well. So I have a huge passion for both real estate and for the first responders that I know and work with. And it's for that reason that I love helping them in the aspect of real estate. I believe that it is still the greatest generator of wealth for the middle class. And I think it can drastically change your life. And most importantly, it provides shelter. So today we're going to go over a few things. As you can see in the flyer, we're going to go over the pre-approval process and understand why it's important to get pre-approved, and then how that really sets the foundation for your home buying journey. Secondly, we're going to go over any tips that you can use in order to help yourself make the home buying process a little bit smoother. And then we're going to go into our 90-day process. We'll go into a step-by-step guide in planning your home buying journey and get that done within the next 90 days. Let me go ahead and move the slide and we'll get going. So why buy a home? Well, as I mentioned already, a home first and foremost is going to be a means of shelter. And that's probably the biggest reason that we would want to buy a home, is to provide shelter for ourselves. And there's other ancillary reasons that we would want to buy a home. It allows you to become a homeowner in a community that you're wanting to live. It allows you to start building wealth using a home as a tool. And then it provides you permanent shelter and protection for your family that can be either passed down by generations, or you can use it to move up onto your next home. So there's an interesting study by the Fed that shows the difference in net worth for a homeowner versus a renter is staggeringly different. For a homeowner, the average net worth is right around $296,000, whereas a renter is around $10,000. Now, again, there's nothing wrong with renting, but most likely you're here today because you want to purchase a home, and that's a big reason. It's a huge piece of financial security. So that $286,000 difference is a big reason why a lot of people are buying homes. And then when is it a good time to buy? That's always the topic of discussion, whether the market's hot, whether it's cold, or right now where the market's kind of flat. I mean, there's not a lot of appreciation or depreciation. And that's kind of what's forecasted for the next year or two, is a flat real estate market. Now, I personally love. I'm going to go ahead and mute somebody. I'm not sure if it's on StreamYard or Zoom, so let me check. Okay. So right now it's a flat market, and flat markets are awesome for me because you can make good decisions based off of the numbers that we're looking at for the current day. So I think it's always a good time to buy, depending on why you're buying. Now, if the market's going up and you're able to catch it on that upswing, it's a good time to buy because you're going to experience appreciation. If it's flat, like I said, now you can make good decisions based off of numbers that are most likely going to stay the same, and you're not risking anything drastically going down. And then in a down market, especially for first-time home buyers, it's going to allow you to perhaps get some deals and some seller credits that you normally wouldn't get. So depending on what the scenario is and what you're looking to accomplish, I think it's always a good reason to buy. And then, like we discussed, how can home buying change your life? The biggest thing for me is it's going to provide you a place of permanent shelter. Secondly, it's going to protect you from increases in rent. And then third, it's a vehicle for wealth. Like there's no other that I've seen that you're able to match. You can use leverage and exponentially grow your net worth. So I'm a huge believer in real estate, and that's why I think if you're looking to get your first home, it's good to know what you're getting into and how you need to go about doing it in order to put yourself in the best situation. All right. So what I've created is a 90-day process booklet, and that's just going to allow you to get ready in order to purchase your first home. Now, this doesn't mean at the end of 90 days that you're going to be into a home. It's basically all of the pre-work that I think is smart in order to get pre-approved, get everything in order. So when you do start your home buying journey, you're very clear on how much you can afford. You're very clear on what that looks like as far as a monthly basis goes. And then you're also clear as what your options are, what type of loan products are out there, all of those things. So when you're out there looking at homes, you understand what you're going to be purchasing and what you're getting into. It is a 30-year commitment. Obviously, when you're doing a 30-year mortgage, most people don't keep them longer than 4 to 5 years, but just in case, we can map that out. So a pre-approval is your first step in your path to home ownership. And it's essentially the lender's conditional agreement that's going to offer you a mortgage based off of all of these things that we look at in your financial standing. 90 days, I think, is an optimal window, and it's going to allow you to do a few things, and we'll go into those. It's going to allow you to strengthen your financial position. It's going to allow you to cure any credit inaccuracies. And it's also going to help you save for a down payment. Now, 90 days in most cases is not going to help you start from zero and save for a down payment, but it's going to give you maybe an extra couple months in order to finish saving for a down payment, or to realize how far out you are from the process and then just plan accordingly. What we want to do is kind of understand what lenders are looking for when we're looking at a pre-approval application. And we're going to go over your credit history, debt to income ratio, employment history, income stability, and then your assets. So when we do your application submission, what we're going to do is we're essentially going to get all these pieces of documentation, provide your credit score, your employment history, and we're going to package it as cleanly as possible in order to give the lender the clearest picture of who you are as a borrower and why you're qualified to purchase a home. Now, a lot of the times you can look at it as if you're, submitting a report or a project for school. If you're giving your employer a resume, what you don't want to do is have a bunch of ragtag pieces of paper, incomplete information, submit it to that person and hope for the best outcome. It's just most likely it's not going to happen. Now, especially with lenders, if we can give them a super clear pre-approval package right off the bat, it's going to make you look prepared, and it's going to answer a lot of questions for them. And if all their questions are answered up front, most likely they're not going to have any questions after that point, which is awesome because they're not going to be digging through all of your finances and asking a million questions. Now, here I have this term an assessment. An assessment can be interchangeable with underwriting. They're just going to assess all this information. They're going to let you know, do you or do you not qualify for a mortgage? And if you do, how much you can borrow. And then once we determine this, you'll be issued a pre-approval letter, which is often required when making an offer on a home. Nowadays, most agents aren't going to go out and show buyers any homes unless they've already been pre-approved, and they want a few different things. They want a pre-approval from a broker like me, and they also want something that's known as DU or LP approval, and that's essentially taking a pre-approval, running it through an automated system for two very large companies. You might have heard of them, Fannie Mae or Freddie Mac. And it's going to spit out an answer in addition to the work that we've already done, stating that you are or you are not approved. With those two pieces of documentation that you present to your agent, they're going to know that you've taken the time to get ready up front, which is going to let them know that you're serious, and then they'll go ahead and start looking for houses with you. So step one is going to be your application submission. Step two would be your credit check. Step three, we're going to verify all of your documents. And then step four, like I said, we're going to do that assessment or underwriting as far as how your whole pre-approval process is going to look. Now, as far as the documentation that we're going to need, this is a very basic list, but most often this will cover everything that we need. If you're a first-time home buyer and you're not really self-employed, then this right here is what we're going to need. So 2 pieces of identification, that should say pay stubs, not pay tubs. Last 2 pay stubs, 2 months of bank statements, the last 2 years of your W-2 and 1099. So for right now, the time this is being recorded, all of your W-2s are most likely being printed out, handed out, and they'll be there before February 1st. So you'll just grab that, grab it for 2022, and you have that item already checked off. And then if you are self-employed, or if you have any additional income to your normal job, then we would just need 2 years of your tax returns. Now, we don't need all of your state returns, just your federal returns. That form is called a 1040, and it's anywhere from like 1 to 5 pages. Now, section 2 is credit readiness. And this is one that hangs a lot of people up. They either don't know their score, they're afraid to check their score, or their score needs work. And we'll go into what actually makes your credit score up, and then how we can kind of go about improving it if we need to. So as far as your credit score goes, we're going to be pulling something called a FICO score. And that's just the model that we use that is commonplace throughout pretty much any financial institution. And a big point of note here is, when I personally pull my own credit as a consumer versus what would happen if I was pulling my credit as a broker, they're always going to be different. So as a consumer, when you pull your own credit score on like my free credit report.com or Credit Karma, you're going to get most likely a higher number than I'm going to get when I would pull your credit score. So always keep that in mind. And they're just based off of different scoring models. So the FICO model that we're using, this is how your credit score is going to be broken down. 30% of your score will be calculated based off of how much you owe. 10% is going to be off of your new credit. 15% will be off of your length of credit history, just meaning how long your average accounts have been open. As far as credit mix, it's just what types of credit do you currently have? Do you have a car payment? Do you have credit cards? Do you have installment loans? Things like that. And then the big one right here is payment history, 35%. So obviously that's a large portion of your credit score, and that's for a good reason. As far as credit report accuracy goes, prior to starting the whole process, you can either get a credit report with me, or you can go to a free site like myfico.com. And then what you want to do is you want to go through every single item, and you want to report it for any, or look through it for any inaccuracies. If you do see any inaccuracies as far as collections, accounts that aren't yours, things like that, you can go directly to those credit bureaus. Excuse me. At the very back of your credit report, you will, at the very back of your credit report, you'll see a few different contact pieces of information as far as Experian, TransUnion, and Equifax. And you can see their contact information. You can contact them directly, or you can reach out to me and I'd be happy to help you with it. In addition to improving your credit for the credit report accuracy, we do want to lower your credit utilization. So you want to keep all of your available credit lines below 30%. So if you have $1,000 credit card, the balance needs to be kept below $300. If you do that, then we're going to maximize your score for that portion of your credit score. So we see amount owed as 30%. As long as we can keep all of those lines below 30%, you'll get the highest amount of points possible for that score. As I mentioned, payment history is 35% of your score. So it's extremely important to make all of your payments on time. And if your budget allows, pay off the cards in full. And then the last one is a big one, avoiding new credit. You want to avoid taking on new credit. And the reason this is each time you pull your credit, it's going to drop your score. And if you pull your credit and then add additional debt, and then we get your credit utilization above 30%, that's going to further drop your score. The number one thing, and I'll go on this later, is do not apply for new credit when you're applying for a mortgage. It's just not a good idea. And if anything mortgage or real estate related, it's always easier to ask if you can do something and then get that answer and proceed accordingly, as opposed to doing something that we can't undo. Because once something's done like this, we can't undo it. And if your score, let's say, goes from 680 to 640, you went from being approved for a mortgage to possibly no longer being approved for a mortgage. And if you are still approved, what is most likely going to happen is your credit scores dropping is going to affect your interest rate by a significant amount. In that example, if you go from a 680 to a 640, you're going to have a higher interest rate, probably a significantly higher interest rate. And then the cost for either one of those rates is going to go up dramatically as well. Now, as far as the timeline for credit improvement goes, Most often you can get something like a balance being paid down. We can fix this in 30 days and then rescore you. But the inaccuracies, collections, things like that are not yours usually take 60 to 90 days. And that's honestly a big reason why I have this as a 60-day, or I'm sorry, a 90-day booklet, because you don't want to have to be dealing with this when you're in contract on a home or where you're looking at houses. It's just going to be stressful. And if you can't get it removed, then it's going to affect the whole process. And then once you've already pulled your credit, a lot of banks, like credit unions now, since this is a first responder seminar, a lot, like I know the bank that I use, Firefighters First or FNA or certain police credit unions, they'll have free credit monitoring for you. I highly suggest that you subscribe to it and then monitor it on a monthly basis. That way, if anything does pop up, you can handle it immediately. And then what to avoid. What we want to avoid, like I said, you don't want to open any new accounts. You don't want to close any existing accounts. And this is for that reason, you're going to affect your credit timeline. So if the average age of your accounts is 10 years and you drop the oldest account, it's going to drop your average age of accounts, which in turn is going to hurt your score. We already talked about don't apply for new credit. And like I said here at the bottom, it can always be, it's always easier to discuss something upfront as opposed to doing something that cannot be undone. Now, section 3 is titled Getting Your Assets in Order. And this is an important step also. We'll go over the basics, and I have a few tips later on that we can discuss as well. So what you want to do at a base level is you're going to want to get 2 months of each statement that you're going to be using for your purchase of real estate. So on step 1, it says documentation of assets. Collect your recent statements from all bank accounts, including checking, savings, and investment accounts. Make sure it's 2 months. Make sure it's in a PDF format, like we discussed at the start. You don't want to have screenshots of your accounts. I know it's very commonplace for all of us to be sending screenshots of various documents now. Lenders still are not on that same page, so make sure it's a PDF. Make sure there's no missing pages. And let's say you've scanned this document and it's a PDF. Even if the pages are blank, you have to include them. So if it says 1 through 5, and let's say pages 2 and 4 are blank, you still have to include them because the lender's going to want to see that. The second item here is you're going to want to include documentation for retirement accounts like IRAs, 401ks, or for us, 457s, any type of public safety type of retirement plan. These, so 2 statements for this could be 2 months. It could be 2 quarters. It could be 2 years, depending on how your individual retirement plan is reporting. That's what you need. You just need 2 statements for that. And it has to be the 2 most recent statements. And then on the third item here, it says prepare any explanations for any large deposits or withdrawals, as lenders will likely need this information. So 2 things on this. If you have large deposits, the lender is going to ask for an explanation as far as what those are and why you deposited them. And they're going to need backup documentation. So if it was transferred from another account, as long as we have it, we can document it. If we don't have it, we're going to need access to that account. Or let's say it came from a parent or a grandparent as a gift. We'll need something called a gift letter, and I'll go into that in a second. The biggest thing for me on this, if you're planning on making any large deposits that may be hard to source, which is what we call sourcing them, showing where they came from, if you deposit them more than 2 months prior to getting started, you don't have to source anything. So it's in January right now. Let's say I deposit $50,000 into my checking account. I can deposit it in January. I would get my February and my March bank statements, and they would not have that January deposit. And I wouldn't have to explain why my bank balance is the way it is. Now, this helps for a lot of reasons, but if for whatever reason, you may have a hard time explaining, let's say it's you deposit like Bitcoin or something like that, any type of crypto, there's mattress money, anything like that. The banks don't look outside they're not going to be like, oh, okay, well, we're going to accept your mattress money. That's not going to happen. So deposit anything that you think may be hard to source or explain to a lender at least 2 months prior. So you have 2 bank statements without that deposit showing. And if you have any questions on this, you can always feel free to reach out to me. All right. And then the source of down payment, we need to identify where your down payment is coming from, which is why we're asking for the documents that I just went over. And then gift funds are totally allowed as long as they're from acceptable people, usually immediate family members, things like that are totally okay. It's a super simple process. We give you a letter, they fill it out, you sign it, they sign it, and basically the letter is stating, the person who is giving this money to the person who is receiving it for the purpose of a down payment does not ever expect any repayment. And then there's a certain way that I have everybody fill this out that's not going to require any bank statements from the person who is gifting the money. A lot of times people don't have a problem gifting you the money. They just really don't want to provide anybody with their bank statements, which is understandable. So when we do this process, I have a specific way that we fill this gift letter out, and they're not going to ask you for the gift donor's bank accounts. So I find that helps. And like I said, a lot of people don't have a problem giving you the money. It's they just don't want you or anybody else looking at their bank statements. And again, it's understandable. So as far as maintaining asset stability goes, which is item number 3, you want to avoid making any large purchases or moving money between accounts excessively, as this is going to raise a lot of red flags. So with anything that you do with a loan, the more simple you can make things, the better. And on this case, we don't want a million transactions going in and out. I've had clients who are trading money in and out of their checking account for stocks, like 100 transactions. It's not going to look good. We're going to even if it's totally above board, we're going to have to document every single one of those transactions, and it's going to be a pain. So my suggestion always is to have whatever account that you're going to have for your down payment, make sure that account has as few transactions as possible. If for no other time period than the time period that we're requiring those 2 bank statements, make it clean, make sure the balance is not varying widely, and then you'll be good to go. And that's, like I said, for the second point right here, lenders will be reviewing your financial behavior in the months leading up to your mortgage application. So you don't want all these crazy transactions. It's just going to raise red flags. Make it as simple as possible. And then number 4 is prove additional income. So if you're going to be using any additional income from dividends, interest, rental properties, have the proper documentation available. Make sure there's a way to source or track anything that you're doing, and make sure that those will be readily available. Can't write anything on the back of a napkin and expect the lender to accept that. A most common thing that I see is sometimes people are selling dirt bikes, cars, boats, and it's like a handshake deal, or they don't have a copy of the title or transfer. Anything like that has to be documented, or they're not going to allow you to use those funds. They'll do something called backing amount. So let's say you have $100,000 in your bank account. You sold a dirt bike for 10 grand. There's no proof of anything. It's just a cash deposit. You now effectively have $90,000 to use in the lender's eyes. And then the second part of this can include tax returns, rental agreements, brokerage statements, stuff like that. So that kind of ties into what I was already discussing. And then number 5 is reserve funds. So reserve funds are are additional funds that the lender wants you to have in your account after your down payment and closing costs. And this is usually computer generated from the documents that I mentioned at the very start from your DU or LP approval. The lender will say, okay, Tyler Thrush is approved for a $500,000 loan. It goes through all these other details, and at the bottom, it will say he needs 3 months of reserves. So depending on what your total monthly payment is, things like that, I would need at least 3 months in order for the lender to say yes. So if your down payment's 100 and let's say your mortgage payment is $5,000 a month and they want 3 months reserves, you're going to need $100,000 for your down payment, $15,000 for reserves, and then additional money for closing costs. And then if you have number 6 is not really common. I included it on here, but most of the people that I deal with, including myself, you're not going to really need it. But if you have other property or high value assets that you're going to use as collateral, be prepared to provide a recent appraisal, and let's say an expensive watch or something like that. A, it's not commonly accepted, and B, it's just not common with my day-to-day business. So I don't really ever run into that very often. And then number 7 is, again, this is kind of like a double-edged sword. You want to pay down all your significant debts if possible. as this is going to improve your debt to income ratio. But what we don't want to do is pay down all of your debts and then not have enough reserves or down payments. Because again, once all that money's out of your account and you've been used to pay down your credit cards and things like that, and then the lender comes and looks at your assets and say, well, wait, this person no longer has enough money for what we need, you're in trouble. So it goes back to that whole thing. Do this in conjunction with your mortgage broker or lender, and then you won't be in for any surprises. So as far as tips for assets go, I always say start early. Organize all this stuff way before the 90-day mark. Have all of it ready to go. Have it in PDF format. I personally I put everything into Google Drive. I have, whatever I'm trying to do. If I'm trying to buy an investment property or a personal residence, I have my assets, my income, credit score, stuff like that. And it's squared away, ready to go. And it's simple to send to anybody that you want to send it to. Keep your records, including, any bank statements, letters, things like that, anything that's going to document all of your assets. And then understand your liquidity. This is, some assets are going to be liquid while some are not. And lenders are going to prefer liquid assets versus those that are not liquid. And this is mainly referring to the fact, let's say you have stocks that are going to be the main source of your down payment. What you don't want to do is offer on a home on a Friday, get your offer accepted on a Monday, only to find out those stocks this is an extreme example, but take 90 days to liquidate. You're not going to have those funds in a time frame that's going to allow you to purchase that house, because nobody's going to agree to a 90-day escrow unless we're in an extremely slow market, which I mentioned we're not. We're in a very stable market. So don't count on assets that you can't convert fast enough. Now, how does assets have an impact on your mortgage approval? The more assets you have, the more you're going to be potentially allowed to borrow. This is also something that happens a lot too. Let's say your credit score is borderline in between a bracket. Let's say 680 is your credit score, and the lender in that bracket is going to be a little bit more conservative as far as issuing pre-approvals. But if you have a 680 credit score, but you have a ton of assets, that becomes something called a compensating factor. And the lender is going to look at those additional assets favorably in regards to your 680. So if you have a 680 and you have $100,000 in your bank account versus somebody who has 680 and has $10,000 in your bank account, the compensating factor of that $100,000 is going to make it more likely that your loan is going to get issued a pre-approval through LU or DP. I'm sorry, DU or LP, and it's going to help you out. So that's a big reason. Interest rate, like we already mentioned, it's a compensating factor. If your assets allow you to either buy the rate down, or it just shows a strong financial position, it can help you out with your interest rate. And then in line with both of those, it's going to give you better loan terms. Anything that you can do to strengthen your position on any of these is going to help your loan terms. All right. So section 4 are the top 10 things not to do when preparing to buy a home. And it's obviously important to know what to do when you're buying a home, but it's equally as important to know what not to do. And like I mentioned earlier, a big reason is because you can't undo a lot of things once they're done. So I have already gone over this twice, and I'm going to do it again because it's super important. Do not apply for new credit. If there anything else you take from this entire thing is don't apply for new credit when you're looking to purchase a home. It's going to mess up your credit score most often. It's going to increase your debt load. And it's just a variable that it's extremely hard to undo, and it's just not worth it. The biggest thing that I see is somebody gets their offer accepted and they want to go buy a new TV, a new furniture, new appliances, all of which are totally understandable. I mean, you want to do that. It's an exciting time when you buy a home. You just have to wait until the house closes. If you got to sleep on an air mattress for a day or two, it's not going to kill anybody. And it's a lot better than getting really far down the process only to find out that you no longer qualify for the home. And a big reason for that is if you have something that's called earnest money, which is basically a small portion of your down payment. In California, it's usually 3%. So if you were to buy a house for $100,000, you're going to put 3% down. That would be $3,000. you put that at risk if you get far enough in the process and then you're no longer approved for a home. So just again, do not apply for new credit. Give me 1 second here. All right. Number two is don't close any credit accounts. And then closing credit accounts is going to affect two things. It's going to affect your credit utilization ratio, which we've already discussed, and it's going to affect the length of credit history, which also can lower your score. So do not close any credit accounts. The hard part is people start paying their debt down when they're getting ready to buy a home, and unknowingly they start just closing accounts thinking it's going to help, and it's actually going to hurt. So don't close any of your credit accounts. And then don't make any large unexplained deposits. Again, we already talked about this. It can raise questions about the legality of the funds and the source of the funds. Now it's a little bit more commonly accepted, but even as like early as 21, 22, any type of crypto was like not allowed whatsoever. I had a client who had a lot of Bitcoin. That was going to be the majority of his down payment. I was even unfamiliar with crypto at that point, and having to source that was a huge hassle. And he had more than enough assets in those accounts to take care of everything, but the lender had a really hard time accepting it. So again, anything you want to deposit to at a point to where you have two very clean bank statements, and you'll be okay. And then another thing is lenders also need to ensure that no additional debt obligations are created from such deposits. So if they see an unexplained deposit and perhaps it's something like a loan, they're going to want to see how much your monthly payment is, what the terms are, and that can affect your pre-approval as well. Number 4 is don't shift finances around without a paper trail. So again, like I mentioned, the most common thing I see is money being traded between spouses. That's probably the number one. And then number 2 is brokerage accounts like stocks, bonds, crypto. It's just, there's a whole list of these transactions every single month, and you have to source every single one. It's just a huge headache. So let's say your checking account is where all of your activity is. Put your down payment in your savings account where there's probably not a lot of transactions going on. Leave it money in there for at least 2 bank statements, and you're good to go. You provide your savings statement. There's literally no transactions on there. The balance is appropriate for what you're trying to put down, and then there's not going to be anything that's asked. Number 5 is do not co-sign loans for others. This is going to affect your debt to income ratio, and it can impact your ability to qualify a mortgage. So a lot of people don't realize this. They think they're helping a family member out, a kid, a brother, a sister, a girlfriend, a husband, a wife, if they're not going to be on the loan. If they are on the loan, that part doesn't matter, but they don't understand that that's going to be counted against them. So if you get this car payment for, let's say, your brother, and it's $700 a month, that $700 a month you're liable for. So you have to have that income in order to qualify for that, and it's going to reduce what you qualify for in a home loan. So just keep that in mind. And then number 6 is do not change jobs or become self-employed. Now this one, there's like a little caveat with this. Lenders want to see reliable, stable income, and any type of new job or self-employment status is going to affect this. Now, that being said, if you're a W-2 employee, meaning you're not self-employed, you get your paychecks from the lender, you get your W-2 issued at the end of the year. If it's in the same industry, so I'll use firefighter, right? If I go from one department to another, it's not going to be a big deal because I have a history of being a firefighter. So that's not going to be a problem. And this comes into play like if you're switching industries. If I go from a firefighter to, I don't know, a software engineer, there's not really a lot of continuity there, and they may question a lot of things. And where this comes into play big time for a lot of public safety personnel, first responders, is overtime. So let's say you go from LA City Fire Department to LA County, which is kind of common. If you have a history of overtime with LA City, LA County obviously has a history of overtime right now. You can use that overtime to qualify. But do not go from W-2, like let's say, like I said, a fireman, to self-employed, owning your own business and no longer a fireman. They're not going to count that income for at least 1 year, but 95%, it's going to be 2 years of stable self-employed income prior to being able to use that income. And this brings up a good point too. A lot of first responders usually have like side gigs, side jobs, all kinds of stuff, selling e-bikes, doing mortgages, whatever it is. You have to have 2 years of that income in order to use that as well. Do not make large purchases. I already mentioned cars, appliances. This is going to affect your debt to income ratio. And like I said, the biggest thing is just wait until you close and you can do whatever you want. The lender's only allowed to look at stuff prior to you closing on the home up to closing the home. After that, they're not going to ask you for your bank statement 2 months after you own the home and want to make sure you're spending money the way they want you to. They have no say into it. So wait until you close to make any big purchases. Number 8, this seems like common sense, but this happens sometimes too. Do not skip your bill payments and do not make late payments. So your payment history is 35% of your score. Do not make late payments. Do whatever you can not to make a late payment. It's going to impact your score, and it's going to show the lender that you're not reliably making payments, to which them, if they're about to loan you 95% of your purchase price of your home, it's not going to look good. Number 9, do not spend your savings. So like I mentioned earlier, you're going to need funds for your down payment, you're going to need funds for your closing costs, and then you're going to need funds for your reserves. So once you have that general amount, just you can't save it. So depleting it is going to be a red flag for lenders. So like I said, set it aside perhaps in a savings account where you don't touch it, and for sure the balance doesn't come down, and then you'll be okay on this one. And then 10 is do not be unresponsive to lender requests. So this is a huge one, and I'll kind of go into detail a little bit as far as why this is. Anytime that you give the lender more time to look at your loan application, they're going to. So what happens is, and this is why I set all this up front when I'm working with my clients, whoever you're working with, you take all this work up front, you get everything ready to go, you have your whole package ready, you followed all of the previous rules that we've discussed, you get a pre-approval issued, and then you get a house into contract, everybody's excited, you go into escrow, and then what happens invariably is buyers and borrowers tend to slow down on the responsiveness because that initial excitement is kind of gone. As soon as we get that approval issued, if we can get them documents, all the documents that are clean, crisp, no screenshots, no like ripped pieces of paper, if we can get that to them within 24 hours and they do not have time to relook at the file, you have a very high likelihood of everything being signed off. And if everything is signed off, you have something that's called clear to close. I mean, they're no longer going to look or request any additional documentation. It is a huge asset, and it's going to give you so much more time to relax, essentially, as opposed to have this lender continuously go into your file. And if you piecemeal, let's say they ask you for 10 additional items after you've been approved, and you send your lender one item at a time, and then your lender sends this to the underwriter one item at a time, it's going to make you look unorganized. They're going to look at the file every time you submit something, and it's going to be a huge hassle. And I've seen this a million times. People who submit complete files have a very easy process, and it's super fast, super clean. They have an initial approval. We submit everything that the lender wants clarification on. We get clear to close, and the whole process goes seamlessly, and it's a great experience. And then you have people who are sending you one item at a time. The items are incomplete, they're not clear, and the underwriters are going to continuously ask you for this stuff over and over again, and it's going to just make the process brutal, and nobody's going to like it. And what happens is you risk running out of time for your contingencies, and then you put that money that I talked about, your earnest money, at risk. So don't do it. I know it's not fun to gather bank statements and letters. Just look at it this way: spend 24 hours going as hard as you can to get all the stuff that the lender asks of you, and there's not going to be a lot of work after that. Or you choose the alternate route of piecemealing stuff, and it's just going to be a long, laborious process. And nobody, I'm sure, including yourself, myself, wants to do that. And the underwriter doesn't want to do it, honestly, either. They want a clean file because they want to go on to the next file. So if we help them out, they're going to help us out. And then as far as tips go, consistency is key. You want to maintain your financial habits and avoid any dramatic changes. You want to stay informed, regularly check in with your broker for advice if your situation changes. So like I said, credit score changes, anything, let me know right away, and I'd be happy to help you and give you guidance. And then you want to be proactive, address any potential issues early. That way we avoid any surprises during the application. So if you do something that you thought, oh no, I bought an appliance I shouldn't have, don't hide it. It's going to come up. Just let me know right away, and we'll attack it head on. And again, how does this impact your mortgage approval? It's going to be much smoother, like I just mentioned. You're going to have better terms and rates, and you're going to have a much stronger chance of a final loan approval. And that's what I was referring to. So as far as do this, and as far as Section 5, it's, we now know what you don't want to do. We will highlight what you do want to do, and then I'll try to wrap this up so we have about 10 minutes for questions. I see some of you on Zoom and then some of you on StreamYard. So depending on what you're on, I'll try to toggle back and forth. So number one, like I already discussed, you want to regularly monitor your credit. If you are in one of the credit unions that I mentioned, make sure you're regularly monitoring it. If it's inaccurate, make sure you report it. And then you also want to make sure that the big thing for me is make your payments on time, keep your credit utilization under 30%. So if you have a $1,000 credit card, make sure the balance never goes above 300, and then you're good to go. Again, maintain a consistent income. You don't want to get a lot of unscheduled time off or unpaid time off. I'm sorry. You don't want any big dips in your income, because it's going to hurt your chances of getting approved. Now, going up helps, but again, you're going to have to source it, and we're going to have to say that it's a reliable increase as well. Save aggressively. You're going to want to increase your savings rate to boost your down payment. And then I would always say consider automated savings. I had an old squad partner who was very good at this, got paid, went into an automated account every single month, and he increased his savings as well. I was discussing this with my daughter last night, and I wanted to highlight this with her. I cut all unnecessary expenses when I bought my first house. I saved as much as I possibly could, because knowing what I know on my side for doing the mortgages, you don't ever want to get out looking for a house, get under contract, only to come up a little bit short. It was my goal to have enough money to cover my down payment, my closing costs, and any unexpected expenses. So at the end of the day, I had enough money. Remember, a house is a good way to look at it. Like I said, your appreciation is going to increase your net worth dramatically, but each month you pay, you're also paying principal down. So this is a forced savings account too. So don't look at it as this money's going away and you're never going to get it back. It absolutely is. And you're going to earn, appreciation on the home as well. So you want to minimize debt. Like I said, do not take on any new debt. I've already beat that horse dead enough. So budgeting for home ownership costs, I would create a budget right off the bat. Once we tell you that you're pre-approved for a certain dollar amount and this is what your expected mortgage payment is. I've discussed this a lot with people this year, especially first-time home buyers. It's going to get you in that mindset of paying that payment every month. And number two, it's going to help you save money. So the example I recently used was the person's going to have a $3,500 a month mortgage payment that we approved them for. They're currently paying $2,000 a month in rent. I told them every single month, pay $3,500 like it's your mortgage payment. The rent's going to go to the landlord, and that additional money will go into that forced savings account that we talked about. So that does two things. It gets you used to making that mortgage payment, and you're dramatically increasing your savings rate right off the bat. And that way, when your first mortgage payment hits, you don't have that mortgage payment shock. So I would highly suggest doing that. It's something that I've done. I recommend it all the time, and I think it's a very valuable tip. Again, compile all their documentation early, get everything together early, and present it to your lender early. So you have all their questions answered. We have a super solid game plan, so there's no surprises at the end of the day. I already mentioned this as well. Stay liquid. Don't keep a lot of your money that you're going to need for the transaction in illiquid assets. It's just going to create stress, and it may not come in time. All right. So that's all that I have. I know some of that was redundant. I will hang out for a couple minutes. I'm going to look at StreamYard real quick to see if anybody has any questions. or on Zoom. It's now 9:44. I'll give it about 2-3 minutes, and if nobody has questions, we can go ahead and end it. But while I'm waiting for those questions, first off, just want to say thank everybody for hopping on. I appreciate it. And then number two, feel free to reach out to me. You have all of my contact information here on the bottom of the page. If you want a copy of this booklet that I give everybody, you can request it via my email. You can text me and I'll be happy to send it to you. And then I offer, individualized 30-minute consultations going over your whole pre-approval so you're ready to roll. And then if you need a realtor referral, I can also do that in the California area and sometimes out of state, depending on what state you're in. So I'll give it another minute or so. And then if you have any questions, I'm happy to answer them. If not, we can call it a day and hopefully you reach out and we can go from there. Let me check StreamYard one more time. All right. So I don't see questions on either end. I thank you again for hopping on. If you have any feedback for me as far as what I did cover, did not cover, I would appreciate that as well. So I make each one of these better. And if not, I will talk to you soon. And I hope everybody has a good rest of their day.